Today, we're going to crack open the toolbox that professional traders use every single day. It's this whole world of charts, patterns, and indicators that can seem really complex from the outside. But we're going to break down how these tools actually work together to make sense of the markets. All right, let's get into it. So this is the million-dollar question, right? How in the world do they figure out what's coming next? Well, here's the thing. There's no crystal ball. But what they do have is this amazing toolkit built up over decades to help them answer that question. They're not just guessing, they're learning to read the story the market is telling them. And all the concepts we're about to dive into, that's the language they speak. First things first. Before you can even think about making a move, you have to understand the lay of the land. This first set of tools is the absolute foundation. Seriously, it's like an architect learning to read a blueprint before they even think about starting to build a house. So the very first thing you've got to figure out is which way is the river flowing? Are we in an uptrend where the buyers are clearly in charge, pushing prices up to new highs? Or are we in a downtrend where the sellers are dominating and dragging everything down to new lows? This is the basic context for every single decision you make from here on out. Okay, and this is where it gets really interesting, because you need to know the difference between these two signals. A break of structure, or BOS, is when the price just keeps doing what it's been doing. It breaks a previous high in a nice, strong uptrend. It's basically the market saying, yep, we're still going this way. But a change of character, or CHOCH, that's the first big warning flare. That's when an uptrend suddenly fails to make a higher high and instead makes a lower low. It's a sign that the momentum might be about to flip. So, if market structure is the blueprint, then these key levels are the walls, the floors, and the ceilings that are drawn right on it. Support is like a price floor, where buyers love to step in and buy. Resistance is the ceiling, where sellers tend to show up and take control. Traders watch these zones like hawks because prices bounced off them in the past, and there's a good chance it'll happen again. All right, let's build on that. Once you've got the basic structure down, you can start to see these recognizable shapes forming on the chart. And these aren't just random squiggles. These patterns are like visual maps of market psychology, and they often give you a heads up about a big move that's about to happen. I want you to think of these patterns as the market just taking a big, deep breath. The price gets squeezed into a tighter and tighter space, like a wedge or a triangle. All this energy is building up like coiling a spring, and when the price finally breaks out of that pattern, bam! All that stored up energy is released, usually in a really fast, powerful move that traders try to ride. Now, while those breakout patterns signal that the trend is going to continue, these guys are the opposite. They're warning signs of exhaustion. Take a double top, for example. It literally shows the market trying to smash through a price ceiling twice and failing both times. It's a huge visual clue that the buyers are running out of gas, and the sellers might be about to take over. Okay, now we're zooming way in. From the big picture right down to the nitty-gritty. Every single candlestick on a chart tells a little story about the fight between buyers and sellers in that moment. An engulfing candle? That's one side just totally steamrolling the other. A hammer? That shows a powerful rejection of lower prices. And a doji? That little cross-shaped candle? That's a stalemate. Pure, absolute indecision. All right, now we're leveling up. We're getting into the more complex, rule-based systems. These tools go way beyond just spotting simple shapes. They require a lot more precision, but man, they can give you some incredibly deep insights into where the market might be headed. This one is it's genuinely fascinating. It's all based on a mathematical sequence that you see everywhere in nature. I'm talking the spirals of galaxies, seashells, the petals on a flower. The theory in trading is that crowd psychology isn't random either. After a big price move in one direction, the price will often pull back or retrace a predictable amount before it takes off again. So the tool itself will draw a bunch of potential levels on your chart, but there are two that traders are absolutely obsessed with, the 38.2% level and the 61.8% level. That second one is often called the golden ratio, and it's a number that pops up all over art, nature, and architecture. In the markets, these two levels are often huge, significant zones where a pullback stops on a dime and the original trend kicks back in. And the best part is, using it is actually super simple. You just find a clear move on the chart, say from a low point to a high point. You click and drag the tool from the start to the end of that move, and poof, it automatically draws those key percentage levels for you. Then you just sit back and watch to see if the price reacts when it gets to one of them. So if Fibonacci is like a fancy ruler, then Elliott wave theory is a full-blown roadmap of the market. The core idea is that market psychology isn't chaotic. It moves in a predictable rhythm. You get 5 waves pushing in the direction of the main trend, followed by 3 waves that correct against it. The theory is, if you can figure out which wave you're currently in, you have a pretty good shot at predicting what's coming next. But look, this isn't some loosey-goosey theory. There are 3 cardinal rules that absolutely, positively cannot be broken. For instance, wave 2 can never, ever go lower than where wave 1 started. These rules are non-negotiable. If one of them is broken, your wave count is just wrong. Period. You have to go back to the drawing board and reevaluate everything. Okay, now for what you might call the black belt level of pattern recognition. Harmonic patterns are like Elliott waves on steroids. They're these super intricate geometric patterns with cool names like the Gartley or the Bat. And here's the key. They rely on exact Fibonacci measurements between several points on the chart to pinpoint potential reversal zones with incredible precision. So far, pretty much everything we've looked at happens right on the price chart itself. But what if you want more data? What if you want to look under the hood? Well, that's where indicators come in. Think of them like the dashboard in your car. They aren't the road, but they give you critical info about your speed, your momentum, and how the engine is doing. This table breaks them down really nicely. You've got your momentum indicators, like the MACD, that tell you about the strength of a trend. Then you have oscillators, like the RSI, which help you see if an asset is getting overbought or oversold. And finally, you have volume indicators, which show you how many people are participating in a move. Is there a lot of conviction behind it, or is it just noise? Okay, now this is a huge concept when it comes to using indicators. It's called divergence, and it's what happens when the price chart and an indicator are telling you 2 different stories. For example, imagine the price makes a brand new high, but at the same time, your momentum indicator makes a lower high. That is a massive red flag, warning you that the trend is running out of juice and a reversal could be right around the corner. All right, for our last section, we're going to look at something a little different. We're talking about tools that don't just add something to your chart. They actually fundamentally change the chart itself. They give you a completely different way of looking at price. So on one hand, you've got your normal candlesticks. They show you the raw, unfiltered price, which is great. But man, all that volatility can be really noisy and hard to read. On the other hand, you have charts like Heikin-Ashi or Renko. They actually average out the price data to smooth out all that noise. The result? It makes the underlying trend way, way easier to see. The trade-off, of course, is you're not looking at the exact real-time price anymore. And of course, we've got to mention that sometimes the trader's toolkit can get a little weird. You'll find traders who use things like moon phases, based on the idea that they correlate with market psychology. Now, for most people, this isn't going to be a primary strategy, but some use it as one extra little piece of confirmation. It just goes to show how diverse this world really is. So there you have it. We've laid out a whole workshop full of tools, from basic blueprints to advanced indicators, and even different ways to see the market itself. But here's the real secret. The skill of a great trader isn't knowing how to use every single tool. It's about carefully choosing a handful of them that work well together and building a personal, coherent strategy. So the final question isn't which tool is the best, it's which combination of tools is the best for you.